Hello, everyone. Just making sure this is live. Let me refresh the page. Great. So, hello, everyone, and welcome to OC Live. Happy New Year to everybody. This is our first live stream in 2019. So, thank you all of you that are joining us live today. We feature weekly guests to discuss the latest in blockchain and the current projects that they're working on. Everything from types of blockchains to token economies. And with us today, we have a returning guest. You saw him last month in December talking about non-fungible tokens. And with us today, he is here to discuss security tokens. And he is Christian Kameir, managing partner of Sustany Capital. Christian, pleasure to have you back on the show.
Thanks for having me again, Jose. Good to see you.
Great. So last night you hosted an Ethereum meetup on security tokens, and you had a compliance guy, you had a securities lawyer, and you also had Alin Gorin, which is the founder of GHV Ventures, and he also runs the Crypto Invest Summit in Los Angeles. I think he also just launched one on security tokens. So how did that go last night?
It was great. We had a full room like we typically do, but we had a really good discussion. I think a lot of people learned a lot because our fund just spent a lot of time evaluating this particular topic because unfortunately, as you probably know, in this particular space, there's mostly marketing copy out there, and I always like to say reality doesn't have a marketing budget. And so we're trying to bring in kind of a reality check of where things are really standing rather than aggregating everybody's marketing copy, essentially, right?
Great. So what made you select security tokens as the topic? Is there sort of a lot of interest around that right now?
So yeah, as you probably know, there's dozens of companies that proclaim that they help startups create security tokens. There are a lot of different vendors in that space that say they offer security token offerings and so forth. And a good portion of those entities and projects have been pitching us over the past year. And from our perspective as a venture capital firm, we need to be clearly aware of who are the important players in that field, but then also need to know if startups that we are interested in investing in, if they are using those vendors, whether or not these particular solutions that they are creating have long-term merit, right? So from a very simple perspective, we don't want to end up with a quote-unquote security token in our portfolio that at the end of the day is attached to a vendor that may or may not comply to the future-proof solutions that we need to see, right? I'm going to get more into that, but there's a lot to that people probably don't realize.
Great, and I guess we'll start off on what are security tokens. But you sent me yesterday a presentation that aligns pretty well with the questions I had, so I'm just gonna pull that up and we'll go through that. Thank you for sending this over. Let me hit present to everybody, so everybody should be able to see this now. Let me just make this full screen.
Yeah, so as you know, I like to start off with just basic taxonomy, and this comes back to there's a lot of new technology and new wording that's being introduced. You can skip the disclaimer. I always like to say I used to be a lawyer a long time ago. I've never been a lawyer in the United States. I was a lawyer back in Europe, but ever since I moved to the United States, I haven't worked as a lawyer, obviously. So starting off with just simple taxonomy, just to recall what is a security. So you got your debt instruments, so that includes bonds and banknotes and whatnot, and you got equities. That's kind of the most recognized security. They are specifically your common stocks, and then you got derivatives, you got forwards, futures, options, and swaps, and all of those can be securities and are securities. And then more importantly, what's a token, right? And a token in the sense of the blockchain, if you want to jump to that next slide, should be understood as a technical instrument. And it's often used, if you go back, it's often used more as a metaphor right now, unfortunately. And we like to take a very close technological look because a token in the context of a blockchain is part of the peer-to-peer stack, and they are specifically that instrument basically that you're sending to someone else. The big value there is the obvious one that if it's based, if this particular token is based on a standard protocol or API, like the ERC20 and the ERC721, then it's peer-to-peer tradable. And oftentimes that's also then related to whether or not it's liquid and how many exchanges can carry that token and so forth. And there's, to this day, there's really only those particular APIs that have been hard forked into the Ethereum public blockchain specifically. And if you bought any token in an ICO, it was most likely an ERC20 based token. Or we talked about this last time, it could be a CryptoKitty, which is a non-fungible token, ERC721. Outside of that, security tokens in the technical sense do not exist yet. What I mean by this, there's no security token protocol that exists on the mainnet. So all the providers that proclaim they have a standard and that they create a security token, what they are referring to is an instrument that's being traded on their side chains or their databases, meaning that you actually have to create an account at this particular side chain or database in order to trade it with someone else who also has an account on this particular side chain or databases. There's a few derivations of that, where there's some extensions and tentacles out there where providers create what's called whitelisted wallets that then reach back to that particular user that owns or wants to receive this token. But at the end of the day, it's actually not a mainnet transaction at this point in time. So from my perspective, being more technology minded and not so much marketing minded, there is no security token in the technical sense because of these particular limitations. They're all in a way tethered to the requirements that are being maintained on the mainnet. So as you likely know, if you want to buy a security, there's a lot of restrictions attached to either the security and or also inherent in who you are as a buyer or seller. And oftentimes this topic in the United States is addressed somewhat myopic in the sense of it needs to comply with securities law, and needless to say that that's true for you and me, but sometimes it's not necessarily true for other people around the planet who have different definitions of what securities are. And the token in that sense obviously doesn't necessarily respect any boundaries, any nation states, and who you are. Tokens shouldn't necessarily care. So what problem do security tokens address? Do you want me to jump into that right away?
Before we get into that, really quickly, I want to address security tokens versus utility tokens, and just as an FYI for everybody watching this live, we're specifically talking about the U.S. and the security and the SEC. So can you tell us a little bit about what makes a token a security token versus it being a utility token, and maybe a little bit about the Howey test in the U.S.?
Yeah, actually, I have this further down the slide. So when I encountered the Howey test, I thought it was kind of funny because it's based on case law, as you probably know, in the United States, which is not the case where I'm from. Right? There's no case law. There is no looking back at old cases. And probably most people watching this by now have heard what the Howey test is. It refers to a very old court case. I want to say it was 45 or 1946. Where some orange grove farmer was trying to sell some land and then build some condos, and he was trying to sell the condos basically before they were being built. And I probably don't summarize it quite accurately, but based on that, the Supreme Court, I believe, was defining what a security is. And honestly, it's not very helpful in this particular context, has never been, and I just simply defer to much simpler tests that will achieve the same purpose, but don't necessarily refer to something anecdotally. So if we want to jump ahead to slide 14, I kind of wrote down a rule of thumb, which is really how security lawyers worldwide treat this particular topic. So there's only a few ways that money and value can be exchanged, and they can be classified into 4 buckets. So either I'm giving you money with the expectation that I want it back at a later point in time. We typically call that a loan or convertible note. I'll give it to you. I don't expect anything in return, and we call it a donation, or I'll give it to you and I expect a future product, i.e. I pay Amazon, and in the future I get a delivery of a product. We call it pre-sale. Or I give it to you and I expect a piece of a company and some profits from what you're doing, and we call that an equity. And so that's, in my mind, a much more useful classification for everybody out there to understand how money changes hands, because most transactions will clearly fall in one of those particular buckets. And again, this is not a national topic, right?
Great, most definitely, and I guess we'll come back towards types of capital raising in the U.S. But I guess let's go back to some of the benefits of a security token, and are these benefits also do they also align with benefits of just regular securities?
Yes, to some extent. For the most part, the current state of security token solutions, I would summarize as addressing compliance cost. And you can think of it as compliance cost during the sale of a security. So you need to typically check for the identity of the buyer. So your typical KYC, your customer rules, and you might need to check on the funds that are being attributed to this particular sale. So your anti-money laundering regulations, which also refer back to some of the identity parts. And then in particular cases where a buyer needs to be in the United States and accredited investor, and that definition hopefully changes pretty soon. You need to be able to check on that. And there's a lot of providers in that space that perpetrate to offer solutions to that. You don't actually have to use anybody, to be honest. You can do this by yourself, but needless to say, that would be rather cumbersome. But you could set up all these checks yourselves if you wanted to. Anyway, so compliance costs can be mitigated in that particular sense by integrating one of those providers who then just charges a fixed fee. In the case of KYC, that could be $1 or $5 per person that wants to contribute, and or could be filled in buckets if you have a lot of those, and you pay a set amount for, let's say, 1,000 people that need to be checked. But then I guess the more interesting part to most people watching this, and most people that have been paying attention to this topic, is this idea of capital formation, right? Do you get the idea of having a much farther reach with this particular instrument, because it's a token, right? It's a piece of software that you can list online and then potentially expose to other people around the world, which is typically not possible if you are limited to some form of physical paperwork, which is really no longer the case, but obviously has other limitations. Because most people don't realize, if you look at the stock markets today, they are rather inefficient in terms of actually doing the settlement of these securities on publicly traded stocks, for example. While you can do things such as high-frequency trading, the settlement in the back will actually still take days, and it's not uncommon for those settlements to actually take weeks. There are several companies out there that really just take care of moving those securities around. And those, needless to say, add a lot of additional costs. That comes back to the fact that the current stock markets are a patchwork of legacy technologies. But so the narrow problem that security tokens can address is provide more liquidity to the market space. So for private companies, you get an economic discount feature called the liquidity discount. So if you're doing a calculation of what a company is worth, for example, you will oftentimes, and that's slide 6, you will oftentimes discount that particular entity to compared to other entity providing the same values and services by 20 to up to 30%. And so, needless to say, based on the fact that most companies are private, if you look around the world, that's an enormous number that's not being realized in profits. So this particular slide that you're showing shows how much money was raised in the public markets, which from a growth rate looks fantastic, right? And between 2016 and 2017, public market IPOs raised 55 billion. At the same time, though, private markets raised almost 9 times that particular amount. So, and if you use that particular discount number, there's $100 billion that are being left on the table based on that discount, because those companies don't have that exposure, because these offers don't get the exposure on the public markets.
Great. So to sort of summarize some of the benefits. First of all, lost my train of thought here. So one benefit obviously is that security tokens are on a global marketplace 24/7 versus exchanges that sort of close at 5 p.m. New York time with the Nasdaq. Or and another benefit of security tokens is that they are fractionable, right? Versus a stock, you have to get an entire stock. And there's a lot of interesting use cases.
Right.
We can get into those. One that comes to mind is real estate. But I guess before that, you had a utility token slide. I think we covered this a little bit. But let's talk a little bit about the differences between an ICO, which everybody is familiar with, and an STO, and how they differ from each other.
Yeah, so 2 things to that extent. So a lot of times I get the feeling that people think this topic of utility token is dead, and to some extent it is, because a lot of the quote-unquote utility tokens weren't obviously actual utility tokens the way they were created. There are pure utility tokens still to be had, and I think we shouldn't forget about that. And also specifically, there's laws around the world and also locally in some states that are being drafted that address that particular topic, specifically of utility token, because those obviously are exempt from the securities laws if they fall into this narrow category. So these still exist, and if you can create one of those, if there's actually utility to be had, if this token has actual value, so it's required to operate a dApp, or it represents a membership or a rights token of sorts, or if it's an actual consumption token that's, for example, being burned during a transaction, then there's no need to fulfill any of those cumbersome rules. And the industry, quote unquote, if you want to call it that, has kind of gotten into this mode of just defaulting to doing all the necessary trappings of KYC and AML, regardless of whether or not these criteria apply. And that's mostly due to overcaution or certain recipes that certain service providers just subscribe to the startups who didn't know better. But if you realize that you can still do these instruments, then you don't actually have to do any of those trappings, right? If I sell you an actual piece of software, I don't have to know who you are necessarily, right? And I don't have to pay a third-party provider to check who you are or where the funds came from. If this is something innocuous that I can sell to you and that doesn't trade on an exchange, and that's just like another service that you use on the internet per se. And so if you look around, you'll see that different jurisdictions have been addressing this for some time and are now refining this. And to that extent, those ICOs have been using the same trappings for a long time that now the quote-unquote STOs are using. So this is just a quick screenshot that I took yesterday from ICO Alert. And this hasn't been looking any different than it looked a year ago. So you can already, if you look at those details, see, hey, these particular tokens require you to do KYC, or if you're a US citizen, you can't actually participate because of the onerous security laws here, and the teams don't want to deal with that, which has been the case a lot in the past. 20 to 40% of projects would, out of convenience, simply exclude the United States because the overhead didn't bet including United States citizens into their particular offer. So from that perspective, ICOs and STOs haven't really changed in that sense.
So one particular difference between ICOs and STOs is who you sell to. Most people heard ICOs in the terms public crowd sale, public sale. And with STOs, maybe this is a misconception, but it's usually just accredited investors. So what are your thoughts on an ICO, which is a sort of a public crowdfunding with an STO catered towards accredited investors?
Yeah.
Do you believe ICOs were sort of a bad funding model, or what's your opinion on that?
No, I think it's a great funding model overall, but there's a large misconception out there how they actually work. So we did extensive research into the different projects that did ICOs. So we have a separate guy on our team who's aggregating this data and doing kind of a fund analysis for that. So we did a separate broadcast on that altogether some time ago, but just to recap there, the top, I want to say, if I remember correctly, 59 projects raised 60% of all the quote-unquote money. And what I mean by that is that money specifically came from accredited investors and oftentimes from venture capitalists. So you've got a huge swatch of the market who actually came from professional investors that went into that space and went into the top projects. And you can easily kind of validate this if you go to the CoinSchedule stats and see what the top projects were, and then you can break it down and you can easily more or less Google which VCs contributed to those, and that makes the vast majority of the money. So crowd sale per se is probably not a great term actually for most of the ICOs. And also if you look in practical matters, what happened there most of the time, most of that sale was pretty much done by the time this particular offer went to the public. And that's more a matter of like looking at history and not a matter of how the structure works. But the crowd sale for the most part actually hasn't materialized in the way people think about that. And if you think about this in those terms of what's an Indiegogo and what's a Kickstarter, those are all sort of very cumbersome to pull off, and I think we'll get to this later, but those require a lot more effort, and actually the cost of capital is much higher. What do I mean by that is, if you're doing a crowd sale, it's not like you can put up a website or you can put up a listing on any of those crowd sale websites and your buyers and investors will just show up. You still have to market this particular project and this particular company. And what we saw in the past is you could sometimes get away with 5% of the equity raised going to marketing. So meaning for every $100 that you want to raise, you need to budget $5 to spend, which now is probably closer to 20 and sometimes 50% was something that I think Alon mentioned last night. And so if you look at other funding mechanisms, so if you're going to a VC or to a debt instrument, those funding mechanisms are actually much cheaper, right? So you don't end up with as much cash as you think. And a lot of misconception is based on the fact that there's platforms out there that make it kind of sound like we just listed here and we have so many investors that look at this. But if you've ever done a Kickstarter, I used to do this a very long time ago, you'll probably realize, hey, this is really not how things work. You can't just list it there. You need to spend a significant amount of effort and there's specifically capital to actually attract investors in that space. So long story short, I think crowdfunding overall has been largely overhyped. And needless to say, we kind of limited in this particular space also the number of people who really could participate. It's not easy, right? It's still not very easy to partake in those few ICOs that are still happening, because most of the time you have to already own some form of cryptocurrency, and that's still a very small percentage of the world population who does own any kind of cryptocurrencies. And then you have to jump through a couple of hoops to actually buy a piece of or an allocation of that particular token. So overall, I think it's largely overrated in terms of doing the actual capital formation. And again, this might change while things are getting easier. And I think the quote-unquote SEOs are a good method towards that.
Yeah, and we might see some future regulation on that in the future. Sort of where you mentioned how we have the Indiegogo model, which is a little bit more complex. But let's get into regulation on different types of fundraising models in the U.S. So we talked about ICOs and STOs, and I guess we'll mention IPOs here because that's something everybody's familiar with, and I think from the meetup yesterday, it's something that's changed over time, where now it's only huge companies that are doing IPOs. So I guess we'll get into financial markets around the world, or financial regulation in regards to STOs and fundraising.
Yeah, so I see the Swiss suggestions in front of me. I don't know if that's what everybody is seeing, but I just list this to just showcase again that this is not a national topic. I mean, it's very important for most people in this space to realize, hey, there might be a better jurisdiction out there that you could utilize to launch your particular token. The US is not necessarily best place to do that, and maybe you don't have to jump through the different hoops that the US sets for us. And even if you jump through those hoops, and this is a slide that I almost always include when I do these things, is it doesn't keep you safe from any of the other regulators. So even if you conform with whatever the Securities and Exchange Commission thinks you should be conforming with, it doesn't necessarily mean that the IRS will agree with your way of selling things. And if it's a pre-sale, you also need to be paying taxes on certain things. And if they decide, well, you actually pre-sold a service, but the SEC takes a stand, this is securities, those things are not necessarily exclusive. So you can put yourself in pretty tough spots. And I know of at least one case where the IRS deemed one of those pre-sales that they totally conform to all of the trappings of the securities sale. But the IRS decided, hey, that was revenue, so they had to pay taxes. And what happened during the same time, they raised their money, obviously, in Ether, which is another point that people always forget, because out of tradition and out of the necessity of language, all of those sales in the token space are always typically listed as US dollars, which most of the time these projects actually didn't raise a single dollar. They raised Ether and or a few other quote-unquote cryptocurrencies. And so what happened in that particular case that was reported to me is they raised a certain amount of Ether at a certain time. The IRS looked at that, looked at the valuation of Ether, and that was the tax bill that this particular project got. In the meantime, Ether lost a significant portion of its value, which basically put that particular project into a situation where all of the money that they had raised, that they thought that had raised, was due based on the tax bill. So that's kind of a long story just to kind of relay that, hey, it's not enough to pay attention in the United States to one regulator. You really have to pay attention to all the regulators, unfortunately, and they don't agree. And then if you go further down the line, if you issue your ICO or STO in a particular state, this particular state might have already invoked certain laws to facilitate the utility token or tax exempt the sale of a token. So that's the case. I don't know if I listed all of those, but in Wyoming and Nevada and Delaware to some extent, and Colorado is looking at specific regulation to that extent. But again, it doesn't help you nationwide. It doesn't help you with any of the federal authorities at this point in time. My hope for the future is that this is going to, this meaning utility token clarity, is being rolled out across all the states. But as far as I know, this typically will take a decade. And so for most projects out there, that's obviously not really an option.
Yeah, and this is something that also raises the costs on that compliance and legal work related to doing an STO and ICO. But hopefully in the future, I don't know if it'll happen, but maybe there'll be some consensus to make it easier. But we'll just have to see how that plays out between different regulators as we go, as the industry matures. So I guess we covered this a little bit. If you want to, do you want to breeze through types of?
Sure. And so if you look at the different US security regulation buckets that have been created, so Obama put this regulation A+, the Jobs Act, into place, and this allows to some extent fundraising to non-accredited investor and promoting this particular vehicle. It carries a pretty high cost, mostly in terms of the marketing aspect that I mentioned earlier. Then you got Regulation D, Regulation S, which excludes people in the United States, and then you got this very underused vehicle of Regulation CF, or Regulation Crowdfunding, which limits the amount that you can raise in any given year and makes it not practical for most projects out there. And Alon mentioned this last night in our meetup. There has been a niche for this particular regulation, and there are specifically microbreweries who have been using this particular vehicle. And it comes down to, you need to kind of understand who your particular investor crowd will be. And by crowd, I mean some projects will actually attract a crowd. So that might be the case with something like a microbrewery, where you have a particular base that you can turn to and say, hey, I'd really like to do this in this particular market. Why don't you all pitch in a certain amount, and this will come about. But for other projects, you need way more money, and or you don't necessarily care if they are local and where the money is coming from. And so you're looking for larger check sizes. And so in this particular case, that's not a good tool.
Yeah, definitely. In some of these, it's very important to pay attention to which regulation you go with, and sort of the pros and cons of each. Some of them don't let you market your fundraising round, and obviously, very, very important compliance stuff here. But we're not lawyers, so maybe in the future we'll have an attorney as a guest to sort of get us through more details of compliance and legal in regards to fundraising and
the takeaway, I think, that for all of these points is truly that whatever regulation you're looking at that you need to comply with, that's the rules that you need to build into your token, right? And for the time being, you basically got two options. So either you build a custom contract so that it conforms partially to your ERC20 rules, and other than that, you write the limitations of that particular security into the smart contract itself so that it can't be transferred to people who shouldn't be owning it. And the other option is that the token can only be traded on a platform that specifically looks for those criteria, and people that need to or want to buy it or sell it, they need to actually subscribe to the platform. The platform itself then checks it. And whenever you hear the word platform, just equate it to, it's not a blockchain, right? So whatever is a platform is not a blockchain, it's the opposite of it. And I think you're showing the secondary trading slide. So if we move on towards, hey, how do I create liquidity in the first place, then you need to work still with a couple of broker dealers or listing agents out there to sell this. And then after that, the hope from buyer's perspective is often, hey, does it have liquidity in the secondary trading market? And there's very limited options out there right now with a very low liquidity by themselves. Most of these platforms just have started. The things that are listed are called alternative trading systems, which are really broker dealers from a licensing perspective. And there's really only 3 that are online right now with pretty low volumes. And there, again, I think that we will see a world marketplace someplace outside of the US taking over a larger portion of the market. From some announcements, you probably heard that Binance specifically reached out to GBX, and they created some form of partnership there. So if you put the two together, if you have a security tokens exchange in the large buying market, the largest cryptocurrency exchange in the world, you might already have a lot of liquidity. Again, it's a wait and see at this point in time. But the short story here is really there's no secondary, or there's hardly any secondary trading at this particular point in time.
Great. So is this secondary trading specifically in regards to securities?
Yes. Yes, indeed. Yeah.
And only for the accredited investors, right? Like you must be an accredited investor to participate.
Yeah, so at the moment, that's true as far as I remember. We looked at all of those in detail. As far as I remember, you actually have to be an accredited investor. Needless to say, you could scale this down, but if, let's say, you got a security token that was issued under the constraint of the crowdfunding requirements, the CF requirements, you would have to look for other requirements in that buyer. So those are much lower. But as far as I know, no one is doing this as of yet. So they actually all require you to be an accredited investor and check for that on their platforms.
Great, and with these secondary trading, we've had the emergence of all these companies here, and I guess we'll end the podcast with first talking about what some of these standards that are coming out, what the role is, and maybe some use cases for security tokens. But
right, so we looked at every single one of those providers. We actually keep a report card internally on all of those. From various different criteria. So technology in general, team, also funding, because at the end of the day, from our perspective, if this is one of the providers, any one of those that you're utilizing as a startup to create your security, we need to know if we want to buy that, whether or not this particular token will be around, right? Because at the end of the day, all of these companies are also startups, and most startups, as we know, fail. And so they fail for different reasons. Either most of them fail because they didn't create product market fit, which I think at this moment in time, there's not a lot of long-term planning in this space to realize where this technology specifically will create value long-term, i.e. a lot of these solutions are purely software, right? You can implement this into a website. There's a lot of open source code on GitHub to be had. I can probably explain to you how to create an ERC20 contract in 20 minutes, and maybe you already know, and then maybe learn a little Solidity to add the other roles to that. And I'm being a little bit facetious here, but at the end of the day, what the token issuer will care about is the liquidity, right? Can I sell this particular instrument, and not so much, hey, I don't necessarily see a lot of long-term value in that particular technology part. It's going to make my life easier, but do I want to pay continuously a lot of money for to a company that created this particular software? I have my doubts about that. So if you look at just this particular slides, they all have kind of a basket of offerings. Some have their own KYC AML solutions integrated. A lot of them are using a third-party provider. Some of them have already some accredited investors on their platforms. And so it's a very wide variety. So what we did with all of them is we looked at all the details of how their technology works and is it future-proof. One thing that I personally take a lot of issue with is when these platforms state that they are supporting and or creating a certain standard or protocol, because from my perspective, it's only protocol if this particular standard exists on a public blockchain's mainnet. And currently, as I mentioned in my introduction, there is no security token protocol on mainnet. So what that means is currently there's two suggestions, two EIPs on Ethereum specifically that address this particular topic, but these are very rudimentary, and even some of the ESCs that I mentioned by some of these companies that are listed, they are nowhere to be found on the public Ethereum website, and we're still trying to get clarification why particular projects out there are calling something an ESC when it's actually not being listed right now by the official sources. I have to get back to you on that, why that is, and maybe they just simply haven't gotten around to it at listing it on Ethereum.org. But at the end of the day, it will always come back to it's uncertain whether or not these standards will actually become true standards in the way that we understand it. Because if it just exists in your database, if it just exists in your sidechain and you report this as a standard, it's still a long way of being part of the mainnet. So at the end of the day, your token that you're creating with any of the providers, you'll be largely limited to that particular environment. So limited in the sense of you might need to pay the provider continuously on a yearly or monthly basis. And you will also be limited to the other people that venture to create accounts at this particular platform. And then lastly, if this particular platform is no longer supported for whatever reason, because that company fails, because it has been a startup and most startups fail, then you need to know that there's a backup solution for your particular security. And so far, a lot of the responses that we got on our due diligence on the particular topic of backup was very hand-wavy. And it comes back to there aren't really standards, unfortunately. And what you're showing right now are the two EIPs, Ethereum Improvement Proposals, that are actually listed. But again, they're very rudimentary. They just started out, and it's going to be months, if at all, these will find their way into mainnet. And also, there's only one or two projects of the one that you showed earlier that are actually seeming to want to apply these particular standards in general.
Yeah, and there's been a lot of talk around different blockchains implementing their own standard or have their own proposals. Swarm itself has their own version called SRC20. There's been some talk with EOS trying to come up with a improvement proposal for a security token.
Yeah, Swarm is a particular use case. Actually, the CEO is a friend of mine, and they're doing something new right now, actually. So they're going to come out with something new in the next couple of weeks.
Great, and sort of are the uses of these EIPs or these like emerging ERCs for security tokens, like what are some of the characteristics of it? Is it like to meet specific requirements of a security?
Yeah, they limit the transferability because by default, I think there's a lot of obviously similarities between the requirements of an ERC20, so a generic token. So you need to comply with the standards of those to, at the end of the day, being able to transfer it eventually peer-to-peer. So that's kind of the base for the most part, as far as I can tell. And again, I'm not a coder. I haven't been a coder in a very long time. But it's still very, very rudimentary, and it's still going to limit just the transferability inside of the token to those people who fulfill the requirement, which lastly brings you always back to the point of we need to really solve identity on the mainnet first before any of these particular security tokens can provide a lot of liquidity. Because unless there's another data silo that confirms that I have the necessary criteria in me, in my identity, i.e. I'm an accredited investor and I'm not a criminal, I'm not part of a country that's sanctioned, that cannot buy securities and so forth. So unless that particular identity exists on a public mainnet, then the only way to verify that I'm able to buy the security still goes back to needing to form back to some data silo that confirms that particular circumstance. So in a way, it's sort of backwards from my perspective to create a security token before you solve identity, or unless you solve those particular findings as far as I can estimate. And there's some beginnings to that, as I said earlier. Some projects have taken to whitelist certain wallet addresses. So where you join a platform and then you identify a wallet that belongs to you, and this wallet is then identified as belonging to a person that fulfills certain criteria. So that intermittently might serve a lot of purposes. But as I said, I think long term it will come down to what identity protocol are we going to adopt, and then from there, we're going to attach the necessary token requirements for securities to that identity long term.
Yeah, we're definitely at an early stage for the protocol, and some people have called 2019 the year of security tokens, and I guess we'll see developments, and maybe we'll keep having this as a topic on OST Live.
Yeah.
But I think one of the most important questions is, what is the like, in your opinion, or from your research, what is the ideal use case for a security token? Why are we doing all of this? So what do you see the use cases for security tokens?
Well, I think long term it will add value to anybody who wants to own or sell a security per se. The immediate use case is limited to a couple of niches where it provides immediate value. I think, for example, in real estate, there's a lot of value to be had. So for REITs, for real estate investment trusts, there's a lot of the overhead that can be programmatically addressed and can make that particular security issuance much cheaper. And then to peel this topic back, I think it's mostly accurately described as RegTech, regulatory technology at this point in time. So you can bolt the necessary requirements from these platforms onto issuance platforms that then take care of certain arduous tasks that right now require a lot of manpower, i.e. distribution of dividends and notification of shareholders, and initially, like we mentioned earlier, just the simple KYC, not simple, but complex KYC procedure. And so it adds value there. I just don't think it's necessarily fair for the most part to call any of these things security tokens just yet. That doesn't mean that the technology that's being provided by these particular providers doesn't provide immediate benefits and cost savings. I think it provides a lot of benefits and cost savings to people that want to issue a security, but it might not necessarily be helpful. That's what we found with working on a couple of those instruments right now, to actually communicate to the investor that this is a token, right? So you're probably at this point in time better off to just point out the fact that you're using advanced technology to take care of some of that particular overhead that's attached to these securities. So just to make one specific example that we're working on right now, so we're working on issuing debt instruments or bond, and typically in bond scenarios, the bond owners only get payment twice a year because of the fact that it's very cumbersome. There's a lot of work attached to that, but if you automate this, you can issue those dividends monthly, right? And that's a huge benefit to the buyer, and may go a long way in pricing this particular bond, or creating liquidity for that particular bond, because it makes it much more attractive. And so there you got your immediate benefit. And I don't know if you're getting an additional benefit by calling it a token when you just say, hey, it fulfills these particular technology criteria. That's typically what the buyer would care about, not that this is a token. Because at the end of the day, this whole blockchain topic and the token topic is fairly new and might create more friction for the time being if this is something that you need to explain to a buyer. And that's kind of what we found talking to a lot of people, investors, broker dealers, in this particular space.
Great, and this has been an interesting introduction, or a great introduction to security tokens. Maybe this will be a continual topic as we see different technologies emerge around this, and further developments. But yeah, I think it's a good introduction. I know you just had a meetup yesterday. Do you have any upcoming events or news from Sustany?
Yeah, our next meetup is going to address specifically actual blockchain implementations, so real-world implementations that are already out there. It's the third week of February, so you can find this if you just look for Ethereum Orange County meetup.
Yeah, I'll add that down in the description as well.
Yeah, then after that, we've loosely scheduled a particular niche on the whole topic of blockchain medicine. So if anybody listening to that has something interested in that space, reach out to me. And then lastly, I'll be speaking at a conference in March on the identity topic. Anybody who's doing anything interesting in solving identity on the blockchain is going to be in Vegas in the last week of March for that particular topic for a 3-day conference that I'll be speaking as well.
Great. So that is Ethereum Orange County. I'll add those 2 links down below. And thank you everybody for tuning in live to OC Live, the first episode of 2019. Hope you learned something new today about what security tokens. Be sure to tune in to our next OC Live. It's coming up in a couple of days, actually. It's going to be Sunday at 8 p.m. New York time, 8 a.m. Taiwan time for those Asian countries. And we're going to have Matthew Aaron. He is the host and founder of the Crypto 101 podcast. So we're going to be having him on next. So thank you all of you for tuning in live. And Christian, thank you for joining us again on OC Live.
Anytime, Jose. Talk to you soon.